Brad Williams, Frugal Finance, an overview of the two previous videos, one on mutual funds, one on ETFs. Collectively, this particular tutorial will be about mutual funds and exchange traded funds. Compliments of United States Securities and Exchange Commission. Why do I use this information? One, it's helpful. Two, it's unbiased. Three, it's from a government source where I'm relying on some impartiality here in terms of their explanations. I can go out and I can read all the stuff on the internet, and it's a lot of anecdotal stuff. So I'm going to trust that some of the stuff is more accurate than what I'm reading online. This is a bit dated, but the principle is the same. Here, we're going to talk about mutual funds and exchange traded funds. It's a complement to the two previous. There'll be links up here if you're interested. If you didn't catch the two previous videos. Mutual funds and ETFs are both popular options to help investors save for retirement and other financial goals. Mutual funds and ETFs have many similarities, but they also have some important differences, and I'll explain those too. Mutual funds and ETFs have common features. SEC registered, offers investors a way to pool their money in professionally managed funds that invest in stocks, bonds, and other assets. Can help investors achieve diversification. That's key thing here. Whether you want to do this on your own, you can build your own portfolio, or you can actually buy a series of mutual funds. For example, if you like the S&P 500, you can buy the S&P 500 mutual fund. You can do the same thing with ETFs, but you can also buy the NASDAQ, either as a mutual fund or as an ETF. A lot of options. You can also buy a technology-driven fund, or a medically related fund, or oil, or precious metals, or probably a crypto now. There's a lot of different options, and I'm not going to go into that detail. It's up to you to find out whatever your interests are. Mutual funds and ETFs also differ in some different ways. How are they bought and sold? Mutual funds, investors buy mutual fund shares through the fund itself or through a financial intermediary, like a broker. For example, to go to Robinhood, Fidelity, Schwab, Merrill Lynch, Morgan Stanley, Goldman Sachs. You can buy through those groups. Shares are redeemable, meaning that investors can sell shares back to the fund. ETFs, retail investors can buy and sell ETF shares only in market transactions on a national stock exchange. Again, you're going to go through that intermediary, the 3 or 4 companies I just mentioned, and you can do the exact same thing. That is, unlike mutual funds, ETFs do not sell shares directly to or redeem their shares directly from retail investors. What does that mean for you? The way that you buy and sell shares will be different depending on whether you invest in a mutual fund or ETF. While it may be possible to hold mutual fund shares directly with the fund, you will need a brokerage account to buy, sell, and hold ETF shares. A broker may be able to help you buy and sell both types of funds. Again, it's ETF. Electronically traded funds. They're electronic. There is no actual paper. A mutual fund, there's actually similar to a stock certificate. A mutual fund, if you ask, they could provide a mutual fund certificate. But in this day and age, everything is just electronic. That's why ETFs are popular. You don't have to deal with this old school legacy methodology. We're now in the advent of really high-tech software. You can do it all ETFs, and it saves everyone a ton of money. How are they priced? Mutual fund investors buy or sell mutual fund shares at the net asset value. What's the net asset value? Let's say you own Disney, DuPont, Amazon, Microsoft, NVIDIA. You looked at those 6 different shares. Okay, they're over here in this pool. Then you have a mutual fund with the exact same portfolio. Let's say this pool over here of the 6 stocks I just mentioned is selling for $100, but the exact same mutual fund portfolio is selling for $98. Why? Why is that? It's a paradox, and people will go, I don't know. Well, think about it and comment. Let me know why a net asset value could be trading at a discount to the actual portfolio. ETF, retail investors buy and sell ETF shares at market prices minus any applicable fees and charges. An ETF's market price may be higher or lower than the ETF. Again, this can also play, but it's not as recognizable. There's generally not too much, well, because of the different design, the different product mix. There's over 4,000 ETFs, and I don't know the strategy. I don't know the objective. There could be some really crappy ETFs out there that are managed by a not so proficient money manager. So they made up some crazy idea. They bought real estate. They bought portfolios of real estate loans or something like that, where there's a market value of those loans, and then this money manager, his or her NAV is below the market value. Again, we're going to run into that paradox. Why? What does this mean for you in regards to this pricing and a possible discount to the NAV? Could also be a premium. Comment. Why do you think a ETF or a mutual fund is trading above its market price? While you could submit a purchase or sell for mutual funds at any point during the trading day, you may not know the exact price per share that you pay or receive until the end of the day. That's the difference here. They're going to calculate, and it's generally the last trading. That's why you see some crazy activity at the end of the day in the last 20 or 30 seconds, because NAV will be priced on the last trade of the day. You can buy and sell ETF shares on a national stock exchange at the prevailing market price throughout the trading day. Again, you can see why people are buying ETFs versus mutual funds. Certain fees and expenses, for example, generally mutual funds are much more costly. Why? Because they're actively managed. ETFs, you're going to get a money manager who's going to go, well, I'm going to buy this index. And they just buy the index. Or they piece together a quasi-index. If they like gold, they're just going to buy a bunch of gold-related indexes. If they like software, they can go in, and I suspect there's probably some software indexes or computer chip indexes, and the ETFs just buy those up. And they can pull indexes into one ETF. So then it's a multiple level of diversification, but it's all, for example, semiconductor stocks. So I suspect the beta of a particular ETF in an index of indexes is going to have a lot of volatility. Whereas if you bought the S&P 500, well, you have 500 different stocks and it's a fully diversified portfolio. Mutual funds can do the exact same thing. But again, you're going to have a team of money managers looking over this particular pool of assets, and it's expensive. So again, you as the investor are paying for that. Up to you. It's up to you as to what your options are. Now, again, keep in mind, if you're working for a large company and they have legacy mutual funds in their 401k and you don't have an option, well, you're kind of stuck between a rock and a hard place. Tell the human resources to get on the ball and introduce some ETFs so you can have options. Bottom line here, look at and read the prospectus. I know it's not something you want to do, but it's required. Read about the companies, not only the money managers, but the sponsors of the ETFs. Look at track records. Look at the history. A lot of ETFs are less than 5 years old. Look at whether they have any positive ratings. Look at the crowd opinion. Same with mutual funds. Take a look. Go over to the fund analyzer in FINRA. I'll leave a link up here. And take a look at the costs and see what makes sense. And you could compare. You can put 3 or 4 different mutual funds to ETFs and look at comparison. You can go online and you can look to see the performance. There's a lot of resources out there. It's just a matter of you taking the time to do your due diligence. Leave your comments. Let me know what's working for you. Let me know your experiences, whether you're a fan of mutual funds, whether you're a fan of ETFs. Leave any helpful tips. Brad Williams, Frugal Finance. Hope that helped. Thanks for watching. See you soon.